Hi, everyone. I'm Caroline Zakarian, and I work in the Office of Civics and Community Services here at the Los Angeles Public Library. Welcome to National Homeownership Month. Today's presentation is called Buying a Home and is brought to you by the Los Angeles Alliance for Economic Inclusion and the Los Angeles Public Library. Today's show, Ryman and Michael Bailey from AEI will go over the process involved in buying a home, including information on loans, mortgages, making an offer, and closing on a home. There will be a brief Q&A after the presentation, so please send us your questions throughout the program. Thank you, and take it away, Michael.
Thank you, Carolyn, for the introduction, and I would like to thank the Los Angeles Public Library for hosting today's virtual workshop entitled Buying a Home. Again, I am Michael Bailey, and my co-presenter is Cheryl Ryman. We will share information today from the FDIC Money Smart program on buying a home, brought to you by the Alliance for Economic Inclusion. So whether you're thinking about buying your first home or you're getting back into the market after renting or other circumstances, this workshop will provide valuable information for your journey. Buying a home is one of the biggest financial decisions you'll make, and with the right information and preparation, you can make it successfully. Over the next hour, we will talk and walk you through the home buying process, from determining if you're ready to buy through successfully closing on your new home. Next slide, please. So before we begin, let me share an important disclaimer. This presentation represents the views of the speaker and not necessarily those of the organizations they represent. This presentation cannot be reproduced or distributed by a third party or on a third party website without prior authorization. Reference to any specific organization does not constitute an endorsement, a recommendation, or a favoring by the FDIC or the United States government. Next slide, please. So let me outline what we will accomplish together in today's presentation. We're going to cover the complete home buying journey, starting with the foundation, determining if you're ready to buy a home and figuring out what you can actually afford. Then we'll explore your financing options, because there are many choices available, more than you might realize, especially for first-time home buyers and those returning to home ownership. We'll discuss getting pre-qualified versus pre-approved, this is an important difference that can save you time and money. We'll also walk through the professionals who will be part of your team during the home buying process, and how to choose qualified, trustworthy help. We'll also walk through the process of making an offer, negotiating with sellers, and successfully closing on your purchase. And then lastly, we'll cover what to do if you encounter difficulties with your mortgage payments, and we'll introduce you to the LA Saves campaign, which can help you build savings for your home ownership goals. So let's start with that soul sign. That's everyone's goal. But before we get there, we need to ensure you're truly ready for this major step. We will discuss how to get ready to buy a home and how to figure out what you can afford. Here's the most important concept I want you to take away from this first section. Buying a home is a process, not a single event. You want to start by making sure you're genuinely ready for home ownership and have a realistic understanding of what you can afford. This applies whether you're buying for the first time or returning to the market after a period of renting. So let me walk you through the 5 main steps in the home buying process. So step 1 is get ready. This is where many people want to rush through, but it's actually the most critical step. You need to honestly evaluate whether you're ready for the responsibilities of home ownership, figure out what you can truly afford, and check your credit history. You can go to www.annualcreditreport.com and review your credit reports. That website is the only place where you can get free credit reports from the 3 nationwide credit reporting agencies. As of now, you can access your reports for free weekly at that site. Checking your own credit report reports does not affect your credit. Again, that website is www.annualcreditreport.com. Step 2, figuring out the financing. This involves learning about mortgages and other financing options, shopping around with multiple lenders for the best terms, and getting pre-qualified or pre-approved. Step 3, shop for your home. This includes assembling your professional team and finding a home that fits both your needs and your realistic budget. Step 4, buy your home. This covers making a competitive offer, negotiating terms, getting a thorough home inspection, and successfully closing on the property. Step 5, maintain your home. Remember that home ownership responsibilities continue long after you receive the keys. Now let's focus on the affordability analysis, because this is where many buyers make costly mistakes. So here's a crucial principle. Only you can determine what you can truly afford, not your real estate agent, not your mortgage lender, and not well-meaning family members. You are the only one who must make the monthly payments and handle the ongoing cost of ownership. Lenders will tell you the maximum amount they're willing to lend you, but that maximum amount is often very different from what you should be comfortably spend on housing. So there are two primary methods to determine your comfort zone. First is your spending and savings plan. This involves analyzing your actual monthly budget to see how much room you have for housing cost while maintaining your other financial goals. Second is your debt to income ratio. This is a calculation that lenders use in their approval process, but you should understand it for your own personal planning. When you're calculating affordability, remember that your monthly housing payment consists of more than just the mortgage. Your total monthly payment is called PITI, which includes 4 components. P stands for principal, the amount you borrow from the lender. I stands for interest, what you pay the lender for the privilege of borrowing their money. T stands for taxes, real estate taxes that go to your local government for services. And then I stands for insurance, homeowners insurance to protect your investment. This is really important because property taxes and insurance can add several $100s to your monthly payment. Many people forget these costs when they're calculating what they can afford. Now let me explain the debt to income ratio in more detail, because this is a critical tool for determining what you can afford. The debt to income ratio is calculated by dividing your total monthly debt payments by your monthly gross income and is expressed as a percentage. This ratio shows what percentage of your gross monthly income goes toward monthly debt payments. Your monthly debt payments include credit card minimum payments, car loan payments, student loan payments, personal loans, and any other recurring monthly debt obligations, and your anticipated monthly housing payment when you're calculating affordability. Here's why this matters. If your debt to income ratio is 40%, that means 60% of your gross income is available to cover everything else. That would be taxes, food, clothing, medical expenses, savings, and other living costs. Different lenders have different standards. Some lenders prefer a debt to income ratio of 36% or less, while others will accept up to 43%, depending on your credit score and other factors. Some lenders may have specialized programs that may help borrowers with even higher debt to income ratios. So generally speaking, having a lower debt to income ratio indicates more financial stability and a greater ability to afford your new housing payment comfortably. Remember this important point. The debt to income ratio shows how much of your gross income goes toward debt, but you still have other essential expenses like food, clothing, medical costs that aren't included in this calculation. So even if you qualify for a certain loan amount, you need to consider whether that payment fits comfortably within your overall budget. Now we're going to move to slide 12. So let me walk you through this example so you can see exactly how this calculation works. So here we have someone with a $2,045 in total monthly debt payments and $3,750 in monthly gross income. When we divide $2,045 by $3,750, we get 0.5453, which equals 54.5%. So what does this debt to income ratio tell us about this person's situation? First, more than half of their income is already going to cover existing debt. This means they only have about 45% of their gross income left for everything else like taxes, food, housing, transportation, healthcare, savings, and other living expenses. So why is this concerning? Because that 45% has to cover all of those things, including taxes, which could be an additional 20 to 30% of your gross monthly income. Second, many lenders would not approve a mortgage loan for someone with a debt to income ratio this high. Most conventional lenders prefer to see ratios of 43% or lower, including the new mortgage loan payment, because statistical data shows that borrowers with higher debt to income ratios are more likely to struggle with mortgage payments or default on their loans. Lenders want to protect both themselves and borrowers from taking on unaffordable debt. So the question becomes, can this person afford to purchase a home right now? Probably not, at least not without making some changes first. But here's the important part. This person has options. They could lower their debt to income ratio by paying down or eliminating some of their existing debt to reduce the $2,045 monthly debt payment. They could also look at less expensive homes, which could result in a lower monthly mortgage payment. They could make a larger down payment and borrow less money, which would reduce the mortgage payment. They could also look into federal, state,
Well, good afternoon, everyone. It seems that Michael's having some technical difficulties with the storm that's going through, so I'm going to pick it up. Hi, I'm Cheryl, and when Michael comes back, I'll surrender the screen back over to him. But as he was saying, the important part when thinking about this area is if you can lower the debt to income ratio. And Michael was indicating that oftentimes you could look into federal, state, or community programs that might help with down payments or closing costs. And there's a lot of those that are available. The key point is this: a high debt to income ratio today doesn't mean that you can never buy a home. It means that you need to create a plan to improve your financial position first. On the next slide, then, the key takeaway for this section is that buying a home is a process. Start by making sure you're ready to buy and figure out what you can afford. Start by asking yourself, am I truly ready for home ownership? What can I realistically afford? Not what they're willing to lend you, but what can you comfortably afford? Laying a strong foundation by assessing your readiness and setting a sustainable budget is absolutely critical for your long-term success. And never let anyone rush you or push you beyond your comfort zone. A home that stretches your finances too far isn't a dream home, it becomes a burden. So it's absolutely worth taking the time to get this right from the very beginning. By being thoughtful and realistic in your planning today, you're setting your future self up for success. And trust me, you'll be grateful that you did. On the next slide, then, financing a home purchase. We're moving into section 2. First, we'll identify different types of mortgage loans that are available to you. You have more options than you might realize, especially if you're a first-time home buyer or meet certain criteria. Second, we'll define important loan terms and concepts that you'll encounter throughout the mortgage process. And understanding this terminology will help you make informed decisions and communicate effectively with your lenders. Third, we'll describe how mortgages actually work, the mechanics of how you'll pay back your loan over time, and what factors affect your monthly payments. And finally, we'll discuss the importance of shopping around for a mortgage and how to compare offers from different lenders to ensure that you get the best deal for your situation. The key takeaway here: know your loan. Absolutely learn about the financing options for buying a home and shop around to get the best deal for you. And I want to emphasize those last two words: for you. The best loan for your neighbor, your coworker, or a family member might not be the best loan for your specific situation. Your income, credit history, down payment amount, long-term plans all factor into what makes the right loan for your circumstances. So on the next slide here, let's start with some fundamental definitions that you'll encounter throughout the mortgage process. So the mortgage is simply a loan specifically designed to buy your home, condo, townhouse, where the property itself serves as collateral for the loan. And what that means is that the lender can foreclose if you don't make the payments as agreed. The principal is the actual amount of money that you borrow from the lender. This is the base loan amount. Costs associated with getting a mortgage include several components. Interest. Now, this is the cost of using the lender's money expressed as a percentage. Points. Some lenders may offer you the option of buying points, where you pay more money up front in exchange for a lower interest rate. And points can be a smart choice for people who plan on keeping the loan for a long time, because the monthly savings from a lower interest rate will add up to more than what you paid up front. Fees. There may be additional fees. These could include lender charges for processing your application, with different various names like application fees, processing fees, underwriting fees. And then there may be other charges, such as an appraisal fee to determine the value of the property. And then, of course, the annual percentage rate, or APR. This is the number that you want to focus on when comparing mortgages. Lenders are required to tell you the APR for any mortgage you're considering. And the APR reflects the total cost of the loan on an annual basis, encompassing not only the interest rate, the difference between the interest rate and the annual percentage rate, but it includes the fees and charges that may be associated with the loan. That's all factored into the APR. This distinction is important. Relying solely on the interest rate may be misleading, as each lender may have different costs that they include in the loan that will affect the APR. By using the APR, you gain a standardized measure that allows for an accurate apples-to-apples comparison across loan offers. On the next slide then. So now let's talk about down payments, because there are many misconceptions about this topic. The down payment is the portion of the home's purchase price that you pay in advance of the purchase. How are you doing, Michael? Are we in? I think you're on mute still. All right, I'll finish this one and then, oh, are you there?
Okay. Yeah, if you finish and then we'll transition to the next.
Okay, all right, thank you. Okay, so the down payment, the portion that you pay in advance, right? So we'll walk through a specific example. Let's say a lender requires a minimum down payment of 5% to approve your mortgage. 5%. Now remember, there was a time when 20% was a typical down payment. So let's talk about 5%. If you're purchasing a home for $600,000, that means you'll need at least $30,000 up front, because 5% of $600,000 equals $30,000. The remaining $570,000 of the purchase price would be the amount that you borrow from the lender through your mortgage. And here's a key relationship to understand. The higher the down payment means the less money you borrow. And when you put more money down, when you reduce your loan amount, it results in lower monthly mortgage payments, less total interest paid over the life of the loan, and if you put at least 20% down, you will not need private mortgage insurance, which we're going to talk about in just a moment. Now, while this is important, you need to understand that you don't necessarily need 20% down payment to buy a home. Many home buyers purchase with significantly less money down. And as we saw in this example, 5%, there are some loan programs that even will go as low as 3%. So absolutely shop around. Just keep in mind when we're talking about the APR and the total cost of the loan over the life of that loan. All right, Michael, you want to take it away on the next slide?
Yes, thank you, Cheryl.
All right.
So now we'll dive into private mortgage insurance, or PMI. So if your down payment is less than 20% of the home's purchase price, your lender will likely require you to carry PMI. This is common for most conventional loans. So PMI exists to protect the lender, not you, in case you stop making payments. It's not the same as homeowners insurance. Homeowners insurance protects you from losses due to things like fire or theft. PMI, on the other hand, protects the lender's investment, much like gap insurance on a car loan. Now, here's the part that affects your budget. PMI increases your monthly mortgage payment. The exact cost depends on your loan amount, your credit score, and how much you put down, but it's often a noticeable increase. PMI can help you buy a home with a smaller down payment, but it will raise your monthly cost. So it's something you'll want to include in your affordability planning. The good news is that PMI isn't always permanent. Depending on your loan, you may be able to cancel it once you've built enough equity, either by paying off a certain portion of the loan, let's say 20%, or after a specific number of years, generally midway through the loan. Some loans require PMI for the entire term, so please be sure to check your loan agreement. Next slide, please. So earlier we talked about the four parts of a typical mortgage payment: principal, interest, taxes, and insurance, often shortened as PITI. Now let's focus on how you'll actually pay the taxes and insurance. There are two main ways this is handled. Option one is through an escrow account. With this method, your lender collects a portion of your annual property taxes and homeowners insurance on a monthly basis as part of your mortgage payment. Then, when those bills are due, the lender pays them on your behalf using the funds held in your escrow account. This is a common setup, and if you're putting down less than 20%, your lender may require it. Option two is to pay the bills yourself when they arrive. This gives you more control. It is less common. Most lenders prefer you to escrow, however, and actually they'll make those payments for you. It's important to note this type of escrow account is different from the escrow process used during the home buying process. In this case, the escrow is ongoing and used to manage your taxes and insurance after you become a homeowner. So many people actually prefer the escrow option because it spreads large once-a-year costs across monthly payments, making budgeting easier. Just be aware your property taxes and insurance premiums can change from year to year. If they do, your escrow amount and therefore your total monthly mortgage payment will also adjust. Slide, please. So now let's talk about the first of two main types of mortgage interest structures. We'll start with the fixed rate mortgage. With a fixed rate mortgage, the interest stays the same for the entire term of the loan. That means the principal and interest portion of your monthly payment will never change, offering predictable, stable payments month after month. But there's an important detail to keep in mind. If you have an escrow account, your total monthly payment could still go up over time. That's because property taxes and insurance often can increase even though your monthly mortgage rate stays fixed. So when is a fixed rate mortgage a good choice? It's a smart option if interest rates are low now and you believe they may rise in the future. Locking in a low rate protects you from future increases. It's also a great fit if you plan to stay in your home for a long time. Fixed rate mortgages commonly have 30-year terms, so if you're looking for long-term stability, this could be the right choice. Key benefit here is predictability. No matter what happens with market rates, your principal and interest payments remain steady. This can make budgeting easier and shield you from sudden payment shocks. Just remember, even with a fixed rate loan, your monthly payment may still change if you escrow for taxes and insurance, since those costs can rise over time. Next slide, please. So now let's look at the alternative to a fixed rate mortgage, which would be an adjustable rate mortgage, or ARM. With an ARM, your interest rate typically starts lower than a fixed rate mortgage, which means your initial monthly payments may also be lower. But unlike a fixed rate loan, the interest rate and your payment can change over time, often increasing. Here's how it works. ARMs are tied to a financial index, such as prime rate or treasury rates, and they adjust on a set schedule like every 1, 3, 5, or 7 years. When the adjustment period comes up, the interest rate is recalculated based on the index and added margin. For example, a 3-1 ARM has a fixed rate for the first 3 years, then adjusts annually. A 3-2 ARM stays fixed for the first 3 years, then adjusts every 2 years. So when might an ARM make sense? It can be a good choice if you plan to sell or refinance before the initial fixed period ends, allowing you to benefit from the lower starting rate. You're financially prepared to handle a potential increase in your payment if rates go up and you're unable to refinance. Or we want to make sure that you're cautious and make sure that you consider this, because if your budget is tight, it wouldn't be able to afford higher monthly payments in the future. So if there were a increase, you would have the potential of running into payment issues. So before moving forward with an ARM, be sure to read the Consumer Handbook on Adjustable Rate Mortgages. Your lender is required to provide it, or you can visit consumerfinance.gov and search for adjustable rate mortgages to get more guidance. The most important thing is to fully understand how much your payment could increase and to be confident that you can manage it if it does. Next slide, please. So now let's talk about conventional mortgages, which make up the majority of home loans issued today. Mortgages generally fall into two categories: conventional or government-backed, or sometimes called government-insured. Conventional mortgages are not tied to any government program. That means there is no special eligibility requirements like military service or living in a rural area. They're open to all qualified borrowers who may, however, they may be more difficult for some people to qualify for when you compare those to the government-backed options. So what do you do typically if you want to qualify for a conventional mortgage? First, a strong credit history is needed. Your credit score affects not only whether you're approved, but also what interest rate will be offered. It's a good idea to check your credit reports from all three major bureaus. You can do this for free at annualcreditreport.com. Again, that's the only official source for free annual credit reports. Secondly, you'll need verifiable income. Lenders want to see a steady and reliable income stream, which you'll need to document through pay stubs, tax returns, or other financial records. Third, your debt to income ratio, or DTI, needs to fall within an acceptable range. While 36% is a common benchmark, some lenders may allow higher ratios depending on your credit score and the size of your down payment. And finally, you'll need a down payment. Depending on the loan program and lender, this could be as little as 3%, though putting down 20% or more allows you to avoid private mortgage insurance, or PMI. The bottom line is, conventional loans are flexible and widely used, but they do require a solid financial profile. While conventional loans are the most common, they're not the only financing option. There are also several government-backed programs that may offer more flexible requirements or better terms, especially for first-time homebuyers or those with limited resources. These include FHA loans, USDA loans, VA loans, and other programs supported by HUD. So let's take a closer look at one example. FHA loans, which are insured by the Federal Housing Administration, are a popular option for first-time homebuyers. These loans often require a lower down payment, as little as 3.5% of the purchase price, and may have more lenient credit and income requirements compared to conventional loans. Another benefit is that closing costs can be rolled into the loan, so you don't necessarily need to pay all of them up front at closing. However, FHA loans do come with a maximum loan amount, and that limit varies depending on where you live. So one important thing to note, FHA loans require you to pay mortgage insurance premiums, or MIP. This is similar to the private mortgage insurance on conventional loans. With an FHA loan, you'll pay part of the MIP up front at closing and the rest monthly as part of your regular mortgage payment. So if you're concerned about saving a large down payment or meeting the stricter credit standards of conventional loans, an FHA loan might be a helpful alternative. Next slide, please. And so in addition to government-backed loans, there are many other assistance programs that can make homeownership more accessible, especially for first-time home buyers. So let's explore a few examples. Down payment assistance programs can provide either grants or low-interest loans to help cover your down payment. Some of these never need to be repaid, while others are only repaid if you sell or refinance the home. Closing cost assistance is another great resource. Since closing costs can total several $1,000s, these programs can help reduce that upfront expense. There's also first-time homebuyer programs that bundle multiple forms of assistance, like favorable loan terms and additional financial support. And here's a helpful tip. Many of these programs define first-time homebuyers as someone who hasn't owned a home in the past 3 to 5 years. So even if you've owned a home before, you might still qualify. Some programs appear toward people in specific professions. For instance, HUD's Good Neighbor Next Door program offers homes at a discount to teachers, law enforcement officers, firefighters, and emergency medical technicians. Your state housing finance agency is also a good resource. Every state has one, and they often offer special terms, down payment programs, or other tools to help people become homeowners. Finally, don't overlook local city or county programs. Many have their own homebuyer system initiatives with unique eligibility rules and benefits. The bottom line, don't assume you won't qualify. Many of these programs have flexible requirements and income limits that are higher than people expect. It's well worth taking the time to see what's available in your area. Now let's talk about amortization, a key concept for understanding how your mortgage payments actually work. When you make your monthly mortgage payment, the amount is amortized, which means it's structured so that part of your payment goes toward the principal and part goes toward the interest. With a fixed rate loan, this payment amount stays the same every month. With an adjustable rate, it may change when your interest rate resets. Your lender will provide something called an amortization schedule, which is a breakdown of how much of each payment goes toward interest and how much goes toward principal. So here's something that surprises many first-time home buyers. In the early years of your loan, the majority of your payment goes toward interest, not principal. That's completely normal. It's just how amortization works. Understanding your amortization schedule is incredibly helpful. It shows you how much equity you're building each month, how extra payments impact your loan, and exactly when you'll pay off your home. Next slide, please. So now let's take a closer look at the difference between pre-qualification and pre-approval and what each process typically requires. Pre-qualification is an informal way to get an estimate of how much you may be able to borrow. It's based on the basic information you provide to a lender over the phone or online. And that could be your employment and income details, how much you plan to use for a down payment, your current debts. There is no paperwork generally required for a pre-qualifier. Additionally, there's generally no credit check and no commitment from either side. The number you receive is just a rough estimate, and most importantly, it's not a loan approval. Whereas a pre-approval, on the other hand, is a formal process. It's a conditional commitment from a lender to lend you money, and it shows sellers you're financially prepared to buy a home. To get pre-approved, you'll need to complete a full application and provide documentation including pay stubs from the last 2 or 3 months,
W-2 forms and tax returns for the past 2 years, recent bank statements, information about your debts and assets, and proof of any additional income you like the lender consider, such as child support or alimony, although you're not required to disclose those unless you want them considered in your loan approval. In today's competitive real estate market, many sellers won't consider offers from buyers who aren't pre-approved. Having that pre-approval letter in hand can make the difference between your offer being accepted or overlooked. Next slide, please. So now that you understand the basics of mortgages, it's time to talk about one of the most important and often overlooked steps in the process, shopping around for your loan. Start by using loan estimates. You can request a loan estimate from lenders, and you will want to request them from multiple lenders. A loan estimate is a standardized document that outlines the key terms of the mortgage, including the APR we discussed earlier. Since interest rates and fees can vary widely from one lender to another, even a small difference, say a quarter of a percent, can cost you tens of thousands of dollars over a 30-year mortgage. The real estate agent may suggest a lender, and that's fine, but don't stop there. Be sure to also get written loan estimates from at least two lenders. Also, you could check on referrals from family or friends, or just check with your own bank to see if they have special loan programs or offer discount rates for existing customers. Keep in mind, loan estimates are free, although some lenders may charge a small fee for pulling your credit report. That's normal, but you should never be required to pay for a full application fee just to get a quote. As you review your options, ask questions. If there's a fee or a term you don't understand, speak up. A trustworthy lender will be happy to explain the terms, and some terms may be negotiable. Remember, this is likely the biggest financial commitment you'll ever make. You have every right to fully understand what you're agreeing to and to shop for the best deal for you. Next slide, please. And so before we move on to working with professionals and actually buying your home, let's pause to reinforce the most important takeaway from section 2. Know your loan. Understanding your financing options and take time to shop around for the best deal that works for you. Now I'll turn it over to Cheryl, who will guide you through the next phase of the process, which is actually purchasing your home.
Well, now we get to the exciting part, getting help and buying your home. So in this section, we will discuss how to put together a team of professionals to help you buy a home. It really does take a village. The major steps to buying a home and where to get help if you find you're struggling to make the payments on your new mortgage. So on the next slide, the key takeaway, get help with the home buying process and interview before you commit to hiring somebody and ask for references. Understand what services you will receive and how much they will cost. Okay. On the next slide, when we talk about putting together your team and finding your home, there are many professionals who can help and guide you in the home buying process. One such professional is the real estate agent, and their job is to help you find the home that meets your wants and needs. They're usually a whole team in addition to the real estate agent that is involved in the home buying process. Others involved may be an appraiser, a lender, an inspector, title company, escrow, and insurance. It can be a lot. So the appraiser provides an estimate of the home's value. And you can learn more about appraisers and what they do by searching Understanding Residential Appraisals at www.usa.gov. The lender, of course, qualifies you for the loan and lends you the money to help you buy the home. The housing inspector identifies key problems with the home, if there are any, before you buy it. For more information on home inspections, also you can go to www.usa.gov and search home inspection, And include your state's name in the search for state-specific information. Each state has different rules and laws. And then the title insurance. Title insurance agents research the legal right, the title to the property, to make sure the person who's selling it actually has the legal authority to do so, and that there aren't any other liens or judgments against the title of the home that may impede your ability to buy it. Then your insurance agent determines whether the property can be covered by insurance and recommends how much insurance you need and how much that will cost. And then housing counselors. Housing counselors can provide you with education and counseling on the home buying process. And you can do this on the front end before you even start shopping. The U.S. Department of Housing and Urban Development, HUD, approves housing counselors. They get certified to provide advice on buying a home. They can provide assistance at any stage of the home buying process, but they're very, very helpful at the beginning to make sure that your budget is in place, that your credit reports and your credit scores are in position to help you qualify for a home. They may be able to connect you with down payment assistance and or other resources. For that reason, it may be helpful to consult with the housing counselor even before beginning to work with a lender. You may visit www.hud.gov, and then you can search for Find a Counselor. Okay. So you've gone through the process, you've worked with your agent, you've gotten pre-qualified, you found a home, you've looked, maybe it's your first, maybe it's your third, maybe it's your 13th open house or site visit that you've done. And this is the one. Making an offer on a home can be both complicated and exciting. So once you find the house that you want to buy, you will make an offer. And this is when you tell the seller, I want to buy your home, and this is how much I'm willing to pay. And usually it's your real estate agents will help you with that. They manage that process. So what's in an offer? On the next slide, your offer to the seller will generally include some very specific information. Of course, the address and description of the property, the sale price, how much money you're offering to pay. Now, some people will go in below the asking price. Some people will go in above the asking price. Your offer will indicate how much you're willing to pay. And then your target date for closing. When we're talking about closing, this is the escrow period. Some people say 30 days. Some people say, oh, I can go as long as 90 days. Some people, they're in a hurry and they're like, we'd like to have it next week, 2 weeks. So your target date for closing, and then the amount of earnest money you're willing to pay. Now, this is a deposit. This can go towards the down payment, but this is a deposit that you offer to demonstrate your commitment. And make it as low as possible, because if you cancel, you may risk losing that deposit. This also shows that you're making an offer in good faith. So what else on the next slide? What else is in the offer? Well, there's some descriptions of who's responsible for paying for what, like the title insurance, termite inspection, if you're going to do a property survey. Also, you'll want to include a walkthrough clause stating that you have the right to walk through the property one last time before the sale is finalized. And this is generally preferable after the seller has moved out, but right before closing. You want to make sure that maybe they had some fabulous light fixtures that you expected to stay, but then you go to do your walkthrough and those light fixtures are missing. Okay. You'll want to make sure that the offer includes the date that your offer expires. If the seller wishes to accept your offer, they must do so before this date. And then any contingencies. And these are statements that must be true or the offer is valid. So this could include you getting financing and the results of the inspection. Special requests. For example, the buyer could request that all of the appliances be included in the sale. Other terms required by laws in your state, or you and your real estate agent might think that there are other things to include in your offer. On the next slide, so now you've made the offer. You've gone through the process, you've gone house shopping, you're working with your lender, you've made the offer. In response to you making the offer, there's a couple of things that could happen. The seller could accept your offer and negotiations end. Your offer plus the seller's acceptance now becomes a legally binding contract. Or the seller could reject your offer and make a counteroffer. So maybe you came in below the list price, or even if you did come in over, maybe they have other offers that came in for even more. If the seller makes a counteroffer back to you, you have the option to walk away. There's no legally binding contract, or you could accept the counteroffer. You could also make a counteroffer to their counteroffer. The seller could reject your offer and not even make a counteroffer. Or you can walk away from the transaction. Again, there's no legally binding contract until you both agreed. Or you could present a new offer to the seller and the process starts all over again. So as you can see, this can become complicated pretty quickly, which is why it's so important to have the right professionals helping you through this process. If the seller accepts your offer or you accept the counter offer from the seller, you now move forward with the financing and the closing process. A home inspection. Consider including a requirement in your offer that says it depends on the results of the home inspection. This is a type of contingency, and that this means that your offer is contingent on or depends on getting the results from the home inspection and you then deciding at that point if you still want to purchase the home. A home inspection will give you detailed information about the condition of the home before you buy it. Remember, there are a lot of things that as consumers, I'm not a structural engineer. I don't know if the foundation is good or the life expectancy of the roof or the plumbing. So the inspection will reveal any significant issues with the property that may not be apparent without that inspection. And while you can get a recommendation from a home inspector from your real estate agent, make sure that you're getting someone who will put your interest first, not those of the real estate agent who maybe just wants to make the deal. In a home inspection, a qualified inspector takes an in-depth, unbiased look at the potential new home, and it will evaluate the physical condition, including structure, construction, mechanical systems, and identify items that maybe need to be repaired or replaced. And it will also identify the remaining useful life of major systems, equipment, structure, and finishes. In some cases, you may need a secondary inspection. For example, if the property has an unusual heating or cooling system, or if there are foundation issues, you may need to consult a structural engineer. Now, in homes where markets are selling pretty quickly, some buyers may decide to waive a home inspection. Do so at risk. They may be willing to take the risk of buying a home that has a potential unknown amount of needed repair work so that their offer is more attractive to the seller. Just know what you're getting into. It's your decision whether or not to require a home inspection as a contingency to your offer, but either way, you should know your rights and what you're giving up if you choose not to get one. Okay. So now you're going through and everything has been approved. Everybody's agreed that the home inspection went well. Now you're ready to sign documents. You can expect to get the following documents at closing. This is when you're signing your loan docs: the loan estimate, Now, this lays out information about the loan. Now, when you first applied for your loan, you should have gotten something very similar. There shouldn't be a great deal of difference between these. Okay. Then you'll get a closing disclosure. This is the form that lists the final terms of the loan, final closing costs, the details of who pays who and receives what money at closing. Now, your lender must provide this document to you at least 3 business days before closing so that you have time to challenge if there are any questions. And then your initial escrow statement. Michael talked about taxes and insurance and other things within a home mortgage. So the initial escrow statement lists the costs the lender expects to pay from your escrow account. That includes estimated taxes, insurance premiums, and any other charges during the first year of your loan. If there will not be an escrow account, as we talked about earlier, the statement will be blank. Then there's a promissory note. Now, this is the document that commits you to the loan with the bank, and it includes the amount of money that you borrowed and must pay back, the interest rate on your mortgage loan, the dates that you must make the payments, the term or length of the loan, the amount of money you will pay over the term of the loan, and whether or not the payment amounts can change and where you must send the payments. There's a lot of documents. It's a little intimidating. I think oh my gosh, we're running out of time here. I see that. Closing on the next slide then. Let's go really quickly through this. The last step in the home buying process. At closing, the loan becomes final. Woo! Funds are distributed, the title to the property is recorded, and congratulations, you are now a homeowner. Now, there's additional information on getting help when you're in trouble. If you're having challenges making your mortgage payments, don't wait until you're delinquent. Get help on the front end as soon as you realize that you may be having challenges. You can contact your lender. That may be the best place to begin, and let them know. Maybe you've had some injuries, you're not able to work, whatever may be happening. Speak to your lender first before your loan goes delinquent. Okay, then there's also the HUD-approved housing counselors and the State Housing Finance Agency. So the key takeaway to this one is get help with the home buying process. There's a lot of different challenges within home buying. Make sure that you have the right people on your team. Interview before you hire and ask for references and understand what services you will get and how much they will cost. And with that, we won't have time to go through the LA Saves, so I'll turn it back over to Carolyn.
One sec. Hi, okay. I'm back. Okay, so really quickly, maybe we have time for 1 or 2 questions. I have one here. If someone wants to buy a home, what's the first step? Either Cheryl or Michael.
Yeah, I can take that. Look at your income. Look at your income and your debt and determine what your ratio is. Michael talked about that early on. Also, pull your credit reports. You may think that your credit reports are great and your credit score may be good, but you need to look at your credit reports and make sure that they are true and correct. We've worked with several clients, several community members who've not looked at their credit reports and were surprised to see things on there that they didn't expect. Maybe they weren't familiar with, and you want to make sure that it's a true reflection of you. And to identify any opportunities, maybe even to improve that.
Okay, perfect. Thank you, Cheryl. Actually, it's 1 o'clock. Okay, so I'm going to close off here. Thank you guys both for a wonderful presentation. I always learn a lot at these things. Like we bought our second home last year, and I was like, oh my God, all the steps, like it brought back all the memories. I'm like, oh my God, it's such a long process, but we're at the maintaining part now. It is rewarding once it's done.
Yes.
Okay, so I wanted to also remind everyone, if anyone missed any part of this presentation, it is available on LAPL's YouTube channel, youtube.com/Los Angeles Library. We also have a Spanish language version of this presentation called Comprar una Casa on this Wednesday, June 18th at 12 p.m. And for more information on that program and all of our library programs, our website is lapl.org/whatson/calendar. Thank you both again and have a great rest of your day, everyone. Thank you so much. Bye-bye.